Banking in India, definition, functions, and types of banks. Banking in India refers to the system of financial intermediation that involves accepting deposits from the public and providing credit to individuals, businesses, and government entities. Banks play a crucial role in the Indian economy by mobilizing savings and channeling them towards productive investments. The Reserve Bank of India, RBI, is the central banking institution that regulates and supervises the banking sector in the country. Functions of banks in India. Accepting deposits. Banks accept various types of deposits, including savings deposits, current deposits, fixed deposits, and recurring deposits, among others. Providing credit. Banks extend loans and credit facilities to individuals, businesses, and other borrowers to meet their financial needs. Payment services. Banks facilitate various payment services such as electronic funds transfer, issuance of checks, and debit, credit cards. Investment. Banks invest in financial instruments like government securities, bonds, and other marketable securities. Foreign exchange services. Banks facilitate foreign currency transactions and provide services related to foreign exchange. Types of banks in India. Public sector banks, PSBs. These banks are majority owned by the Government of India. Examples include State Bank of India, SBI, Bank of Baroda, and Punjab National Bank. Private sector banks. These banks are owned and controlled by private individuals or entities. Examples include ICICI Bank, HDFC Bank, and Axis Bank. Foreign banks. These banks are incorporated outside India but operate branches or subsidiaries in the country. Examples include Citibank, Standard Chartered, and HSBC. Regional rural banks, RRBs. These banks are established to provide banking services in rural areas. They are jointly owned by the central government, the concerned state government, and the sponsor bank. Cooperative banks. These banks are cooperative credit institutions that are owned and operated by their members to meet their financial needs. Development finance institutions, IFCI, ICICI, SIDBI, IDBI, UTI, LIC, GIC. Development finance institutions, DFIs, played a significant role in financing industrial and infrastructural projects in India. Some of the notable DFIs that have contributed to the country's development are Industrial Finance Corporation of India, IFCI, established in 1948. IFCI was the first DFI in India. It provided financial assistance to industrial projects and played a crucial role in promoting industrial growth. Industrial Credit and Investment Corporation of India, ICICI, set up in 1955, ICICI initially focused on providing financial assistance to the private sector. Later, it transformed into a full-fledged commercial bank known as ICICI Bank. Small Industries Development Bank of India, SIDBI, founded in 1990, SIDBI's primary objective is to support and finance small-scale industries in the country. Industrial Development Bank of India, IDBI, established in 1964, IDBI was initially a wholly owned subsidiary of RBI. It later became a public sector bank and played a crucial role in providing long-term finance to industrial projects. Unit Trust of India, UTI. UTI was established in 1964 as a mutual fund to mobilize small savings from the public and invest in capital market instruments. Life Insurance Corporation of India, LIC. Although primarily an insurance company, LIC has been involved in promoting various developmental activities and financing key projects. General Insurance Corporation of India, GIC. GIC was the sole reinsurance company in India until its operations were taken over by the GIC Re, General Insurance Corporation of India Reinsurance, in 2000. Nationalization of banks. In 1969, the Government of India took a significant step towards social control and expansion of banking services by nationalizing 14 major commercial banks. The main objectives behind the nationalization were spread of banking, to extend banking services to rural and semi-urban areas and promote financial inclusion. Priority sector lending, to ensure credit flow to priority sectors such as agriculture, small-scale industries, and weaker sections of society. Control over banks, to prevent concentration of economic power and promote equitable distribution of credit. Banking regulation, to strengthen banking regulation and improve the banking sector's stability and resilience. The 14 major banks that were nationalized in 1969 included several prominent names such as Punjab National Bank, Bank of India, Canara Bank, Bank of Baroda, etc. In 1980, 6 more banks were nationalized, further increasing the government's control over the banking sector. Banking sector reforms in India, Narasimhan Committee 1 and 2, Nachiket Mor Committee, P J Nayak Committee. Over the years, several committees have been formed to assess and recommend reforms in the Indian banking sector. Some of the significant committees include Narasimhan Committee I, 1991, the committee, headed by M. Narasimhan, was established to review the financial system's performance and recommend measures to improve efficiency, productivity, and competitiveness. The committee's recommendations led to significant reforms, including the reduction of statutory liquidity ratio, SLR, and cash reserve ratio, CRR, and the introduction of prudential norms for income recognition, asset classification, and provisioning. Narasimhan Committee II, 1998, also chaired by M. Narasimhan, this committee was formed to assess the progress made after the first committee's reforms and suggest further measures. It emphasized the need for consolidation in the banking sector, capital adequacy, and the introduction of risk-based supervision. Nachiket Mor Committee, 2013, this committee was appointed by the RBI to suggest measures for achieving financial inclusion and increasing banking services penetration in rural and remote areas. The committee recommended the creation of payment banks and small finance banks to cater to the unbanked and underbanked populations. P J Nayak Committee, 2014, headed by P J Nayak, this committee was tasked with reviewing the governance of boards of public sector banks, PSBs, and recommending measures to enhance